So welcome, Nick Esposito. Nick Esposito is with Homeowners Financial Group, and you are the credit services manager, right?
That is correct.
Yes, and you've helped many of our clients, and all of them happy. And so we wanted to invite you to talk about something that we're getting a lot of questions on, and I actually have a little concern about, and that is the forbearance of mortgages right now, and what that means and what we don't know about what it might mean.
It's something that you probably should be concerned about. I know a lot of people are going through tough times now with the whole COVID-19 situation. So lenders or servicers are offering to their borrowers forbearance, but that's kind of a double-edged sword because, some of them are tacking it onto the end of the loan, but some of them are also giving you 6 months to get back on your feet and then expecting you to make up that dollar amount at the end of the 6-month period, either in a lump sum payment or, adding to your normal monthly payment until you're caught up.
So let me just clarify. When they add it to the monthly payment, they're taking the amount that you owe. So let's say you have a $2,000 mortgage and it's 6 months, you've got $12,000. What do they do with that $12,000? They amortize it over what?
It depends. Some of them want it back, like I said, one lump sum. Some of them are going to give you 6 months. So I'm sure every situation is going to be different. I'm sure they're willing to work with you because the last thing they want is for you to walk away.
Yeah. So the important thing there is what?
Make sure you know going in what you have to do to get out. Because
Right.
If you're having problems making the payment now, it's going to get a lot worse in 6 months.
Right. So they will give you a written agreement. Basically, it's another loan, correct?
Correct.
And if you don't understand the written agreement and what that means, they need to get clarification.
Correct, for sure. Make sure it's very clear clarification.
Right.
Because a lot of people, I think too many people are using this like a crutch, like, oh, geez, I'm having a little bit of a tough time. It is a last resort.
Right, right. So talk a little bit about, I've heard that there are people who are curious, maybe I need it, maybe I don't need it, but I want to check into it so I have it as a safety net. Now, what does that do to the credit score?
Nothing if they check into it. If they actually do go into forbearance, it gets reported on the credit report. I don't believe it's affecting the scores. This is obviously something new for everybody. I don't believe it's affecting the scores because you're not going late. They've put you in forbearance.
Right.
But you cannot do anything with that loan from a lender's perspective for, I believe it's a year. Once it's been in forbearance, you're kind of put on the sidelines.
Okay.
It's almost treated like a foreclosure with a penalty period.
Right. And that penalty period we know is now 1 year?
I believe it is 1 year. That lenders will look at that loan just like they would a foreclosure.
And back in the short sale days and the REO bank-owned foreclosure, it was anywhere between 3 and 7 years that you were
Correct.
kind of in the penalty box for purchasing.
Correct,
But,
depending on what kind of loan you're applying for.
right. So looking at it for only a year, is that all lenders, conventional, FHA, Fannie, Freddie, VA?
Again, this is so new. I haven't seen anyone come out of forbearance yet and try to do anything with a loan. So to be honest with you, I don't know for sure what that penalty is.
Okay. So I don't know if you can speak to this, but I have talked to other colleagues around the nation that they have said that their clients have looked into forbearance, and of course they check the credit score, they do a little check on what they're going to do for forbearance, and that it did have a negative mark on their credit. Have you heard anything like that?
I don't know because I've not pulled a credit report with a loan in forbearance to see what that effect is going to be on the score.
Well, no, it wasn't even in forbearance. They just looked into it and asked about it, and there was a notation on their credit.
That's kind of dirty pool.
Yeah, that's kind of interesting. So the bottom line, I think what you're saying is it's so new, we just don't know.
Correct.
We know the intention is to help.
But as I said, help as a last resort.
Okay, okay.
You don't want to go into forbearance just because it's going to make your life a little easier and you think you're getting a free pass for 6 months.
Right, it may not be free. Well, that leads us to the thing that you're really, really good at, and that's the credit services part of things. Forbearance being a last part, there are options ahead of that. So what can you share with us there?
Correct. What my main job really is at Homeowners is I help guide people through improving their credit scores to be able to apply for a loan or be able to get approved for a loan. And that business has doubled, tripled in the last 2-3 months with, all the guidelines changing when the markets went into turmoil back in March. The biggest one being FHA originally raised their minimum FICO requirement from 580 up to 660. They've eased back a little bit, and it's now at 640. I'm assuming, because this whole industry, after 20 years, you learn everything's a pendulum. They go way too far to one side, then it works its way back. So I'm assuming in the future we will get back to that 580 level or 600, but right now FHA is not an easy loan to get.
Right. What else are they changing? Are there any other guidelines to be aware of?
Well, a lot of lenders, all the down payment assistance programs, at least here in Arizona, are kind of suspended for right now.
Okay.
FHA is also kind of increasing not only FICO score requirements, but they're starting to put reserve requirements and minimum time on the job requirements on some of their loans.
Can you go into that a little bit? What was the minimum time on the job and what's it changing to?
There was none. If you were a W-2 wage earner, as long as you've received one paycheck, you were good to go with FHA.
And now what is it?
Now they're saying they want at least 6 months on the job, only because I would imagine they're worried about people getting furloughed or laid off. So they want at least the 6-month job history.
Which I understand, except if you're on the job for a year, 2 years, 5 years, 6 months, you can still get furloughed.
Correct.
Or laid off. Yeah, I mean.
And you can qualify on the furloughed income, assuming it's enough.
Okay, on the furloughed income. Okay.
Yeah.
That brings up the point, we've got a lot of folks relocating here, certainly from California and other states, but a lot of folks relocating to Arizona. We're the #1 county. Maricopa County is the #1 county in the entire US for the past 3 years for people to move to. So if somebody is relocating, what are the requirements there from a lending perspective?
Job-wise?
Yeah.
Again, if you've got an offer letter from an employer stating what the salary is going to be, or if you're going to a W-2 job, it's pretty easy. There are no minimum time requirements usually, well, at least on the conventional side now with a W-2 job. That requires just, being able to show them one pay stub or 30 days worth of pay stubs to say, okay, here's my job, here's what I'm getting paid, and you're good to go. Becomes a little bit difficult, obviously, if you're 1099 or self-employed. That's a completely different situation. Now you're kind of on hold for at least a year, maybe probably 2.
So you're saying 1099 businesses and employees, so any contract workers that are not paid a W-2, what does that mean for them? They can't get a loan at all?
No, because
Not
right
at
now
all.
there's no way to establish what that income is going to be because they don't know how much you're going to write off against that 1099 income.
Right. Okay. So that leads us to the credit services. So what are the things that people aren't quite aware of that will affect their credit? Like we share with our clients, don't do anything, even if it's going to pay off your car or your truck or pay off a credit line. Our advice is don't do anything unless you check with your lender first. Can you explain why that's so important?
Well, it's important for a couple reasons. And it depends what the situation is.
Right.
Paying off a car gets rid of one active trade line on your report, which hurts your credit because now you've got a little bit less credit history for them to base that score on.
Seems counterintuitive. People don't understand. It's a good thing.
Does,
I paid it off.
That's why you also don't want to, I always counsel people, pay your credit cards way down. Don't pay them completely off. Leave a $5 or $10 balance. Because if it's at zero, that's zero activity. So that's not going to register monthly as a good payment history. The other thing, like a lot of people are petrified, and everyone will tell you, don't go out and buy a car. Don't go buy furniture. The only place that hurts you is in your debt ratio. And because you've got inquiries, because they're going to pull your credit to get that car, or to get that furniture. It's really not hurting your score other than for the inquiry reason.
Okay.
An installment loan, which is secured debt, is helping credit.
Right. So what other tips do you have?
Don't be late. From a credit services perspective, I can help you negotiate, settle, and delete collection accounts. One of the biggest tricks now is to get your rent payment to show up as a trade line, make sure you're on time, but just keep the credit card balances at 30% of the limit or below. I can help with anything but late payments. If you were truly late, very few creditors will remove that late. And the credit card late, in general, it's probably worth 20 to 30 points in your score. A mortgage late, you're going to lose 80, 90 points. Because they figure if you're late on your mortgage, you'd be late on anything.
Right. And how long does that late reside on the credit? How long before it rolls off?
Well, it never goes away completely, but the effect of it diminishes over time.
And how long?
Well, a mortgage late, I would say it has to be at least 12 months. They don't want to see any lates in the last 12 months to even get a mortgage, regardless of what the score is.
Okay. And non-mortgage, another credit line?
Non-mortgage, it's not obviously as important. Credit card lates, like I said, they'll ding your score 20 to 30 points. But as time goes on, once you get 5, 6, 7 months down the road, that one late payment is affecting you less and less to the point where it's almost non-existent. That 20 points is back.
So in credit services, if somebody has a lot of different debt outstanding, do you help with consolidating in any way? Especially,
I don't help them. Okay. No, I don't help them consolidate, but I will counsel them. I actually have a simulator that I work with, so I can manipulate on my simulator balances. Okay. And I can see if I pay a balance down, how that affects the score. I can consolidate and watch what that does, but if I consolidate into another credit card, it's not going to do anything. Okay. Because not only do you have another credit card, it's probably now near its limit.
So you're helping them determine which ones to pay and are going to be most helpful.
And, if they have a card that's a $15,000 limit and it's at 14, and a different card that's $1,000 limit and it's at 9, I ask them to pay down the 9 first because they're getting a lot more bang for their buck.
Right, right. And so that is really helpful. Yeah.
It's just knowing how to manipulate the score.
Uh-huh. So what kind of impact does it have on rates?
Well, when you look at mortgage rates, every 20 to 30 points gets you a better rate. So 640 to 660 is one rate, 660 to 680 it gets better, 680 to 700, all the way up to 740. Once you're above 740, it's all the same. But I would say a person that's 740 compared to a person that's 640, you're looking at a rate difference of probably 1%. So okay. It's a big difference.
Yeah, yeah. It's significant in the buying power, especially now. So what are some of the myths that you might demystify?
That I should close all my credit cards?
Yeah, that's a good one.
That's one of the worst things you can do.
Yeah. So, but it's a hugely beneficial service. I've witnessed it, what a difference it is, and it doesn't cost anything. So to get expert guidance that gets you a better rate, saves you money, may help you buy sooner, and it doesn't cost you anything, it's kind of a no-brainer.
Correct. Their loan officer is actually the one paying me out of his commission.
Right. What would you tell them to do if they're like, that credit score, that credit interest rate seems a little high, what do I need to do? How do they get to you?
Well, they have to, first of all, it has to be a loan officer at homeowners. And that loan officer, and believe me, I get a lot of files that are not, hey, this guy's a 580, he needs a 640 to qualify. I get a lot of loan officers who get it and they see they'll pull a 690 credit score and say, hey, how long will it take you to get this guy to 700? I want to get him a better rate. So we get just as many of those as the challenging ones.
Right.
And with a person like that, it's usually I can usually fix it in a week. Right. I'll find them 10, 15 points to get them over that 700 hurdle.
Well, that is really helpful stuff. We didn't talk about jumbo loans. What's going on with those these days?
They are still around. Some of the investors have backed out. Like I know Chase now is down to 80% max loan to value. Wells Fargo backed out of the jumbo market altogether at the beginning of April. Some of the investors, like I know US Bank, which is one of our investors, is still doing 90% jumbos. Right. Up to 900,000, I believe. 900,000 or $1 million. So they're not doing the $2-3 million loans up to 90%, but up to $1 million. And the only thing they've done, the pricing is a little bit quirky now because you almost can't get, regardless of FICO score, you can't get a 90% jumbo loan right now without paying a half a point or a point.
Right.
I mean, granted, it's going to put you in the low to mid fours, but you have to pay a bit to get it.
Right.
But what makes it even more difficult is they've also increased their reserve requirements considerably.
Mhm.
Like I know Chase lowered the LTV to 80, but now requires 12 months of reserve payments at close. So,
Mm.
geez.
Yeah.
You're talking about coming up with 20% down and having another 50, 60 left
Right.
over liquid.
Right. And so from your perspective, it's just buckle up and see what occurs.
It's ride out the wave because eventually it goes the other way. Always
Right.
does.
I like your analogy of a pendulum, that it
Yeah.
goes one side way over and then, yeah. Well, thanks, Nick. We appreciate the information. And
I appreciate being here.
yeah,
Hopefully it helps. Hopefully it's a little insightful.
absolutely. Absolutely helpful.